Welcome back to the Global Ledger. I'm Justin. Today we're talking about something that almost no one is prepared for. And that is why financial crises today don't take months, don't take weeks, but unfold in hours. If 2008 was a slow motion collapse and 2020 was a liquidity heart attack, the next crisis will be instant. And the reason is simple. Money has become digital. Liquidity has become a shadow system, and balance sheets now move at the speed of code. Let's get into it. So back in the 20th century, a bank run meant that there were long lines, paper withdrawals, clearing delays, and really limited information. Even the Federal Reserve, established to prevent panics, was built on the assumption of gradual disruptions. In a document that we talked about before, the Fed explained, it reminds us that it was created in 1913 to provide a safer and more stable monetary and financial system and prevent system-wide panics. But today, there are no lines, only apps, and trillions of dollars can move with a few clicks. SVB didn't collapse over months. It collapsed over 10 hours. So you could say, welcome to the new speed of money. Even though this was a couple years ago, it's still relevant today. So why are crises faster today? Reason number one, retail money moves at institutional speed. Money market funds settle same day. Treasury ETFs trade instantly. Stablecoins settle globally in seconds. This pipes directly into the Fed's tools, and those are the ON RRP, overnight reverse repo purchases, IORB, which is interest on reserve balances, FedWire, which is intraday settlement. That's the ultimate. That's where everything settles at the end of the day. That's where you settle reserves. And MMF flows into the Treasury bill market. So these tools were designed to transmit policy, but they also create high-speed escape routes. So that's reason number one. Reason number two, shadow banking is the real funding system. Most modern liquidity does not originate from banks. It originates from money market funds, repo markets, securities lending, corporate treasures, right? So these institutions can reallocate billions in minutes. It doesn't take days to do this. So when the Fed describes the financial system as a network linking borrowers, lenders, and intermediaries, and emphasizes that stress in these linkages can cause system-wide disruption, this is exactly what they mean. The linkages are now digital, and digital linkages break fast. So that's reason number two. Reason number three, mark-to-market balance sheets. Dealers today operate on fair value accounting in real-time risk metrics. So when volatility spikes, collateral haircuts widen, and repo rates start to jump, dealers must immediately reduce exposure. No choice, no time. This is, in my opinion, central to the money view. And this is Perry Marling's words. Maybe not his exact words, but maybe something he would say, which is liquidity is the ability to meet obligations as they come due. So when obligations can reprice instantly, so can crises. Reason number four. So that's reason number three. Reason number four, information is instant and often wrong. So Twitter rumors can now move billions of dollars. But it's bigger than that. Depositors see real-time capital flows. Corporate treasurers react to intraday volatility. Entire ecosystems trade based on the same signals. This creates synchronized panic, you could say, not any kind of isolated panic. So in 1907, fear spread by newspaper In 2023, fear spreads by push notifications, so there's a big difference here between these times. So that's reason number 4. Reason number 5, the Fed's safety net is powerful, but it's retroactive. The Fed explains that its role in crises is to provide liquidity, stabilize market functioning, and act as a lender of last resort. It creates emergency facilities under Section 13.3 to support these credit flows during severe stress. But here's the key. The Fed has response tools, not maybe prevention tools, right? So the Fed does not act until the crisis is already underway. That's by design and often mandated by law. So digital panics simply outrun the response clock a lot of the times. So those would kind of be my top 5 reasons I could think of. So let's do a case study on this quickly and talk about why SVB failed in hours. So number 1, depositors were digital corporates, no retail deposits, just thousands of CFOs holding billions, right? So one group chat, billions gone. Okay, so number 2, their money had instant alternatives. Money market funds yield 5%. Treasury bills settle fast. And overnight reverse repo is risk-free. So the Fed itself notes that ON RRP provides a safe overnight alternative for non-bank institutions, anchoring short-term rates. That's great for monetary policy, but dangerous for bank stability. Okay, so that's number 2. Number 3, assets couldn't be sold fast enough. A bank balance sheet is slow. The market for deposits is fast, and that's your mismatch. So those would be, I would say, the 3 best reasons, sections, things to focus on the failure of SVP and why it failed so fast. So digital runs are not bank runs. They're liquidity runs. This is the critical distinction that we talk about, or one of the critical distinctions I like to talk about here in the global ledger. Crises don't start where people think they start. They start on the asset side, move through the funding side, and become visible only when deposits vanish. A digital bank run is really a flight from deposit into money-like instruments, especially treasury bills, MMFs, and reverse repo. That's not just a bank run. That's a systemic liquidity reallocation. So why will this happen again and at a faster pace? Number 1, I think because balance sheets are bigger, deposits are bigger, institutional cash pools are bigger, and MMFs are massive. We've talked about this in prior episodes about MMFs. Number 2, technology eliminates friction. No lines, no limits, pretty much just instant settlement. So that's number 2. Number 3, the dollar system is more interconnected. Shadow banks are the dollar system now. So that's number 3. Number 4, I would have to say regulation hasn't fixed liquidity mismatch. It fixed capital, but liquidity still moves like water, right? So I would say that's number 4. Number 5, this hierarchy of money is really steep. Everyone flees to the top of the pyramid. Treasuries to ON RRPs to Fed Reserve. Okay, so those would be my 5 reasons or things to look at. Where does the Fed sit into this? The Fed's official mandate emphasizes, again, I've repeated this before, stability of the financial system, minimizing systemic risk through monitoring, providing liquidity to institutions under stress. But digital crisis challenge this model because monitoring lags real-time flows. Funding stress emerges before data updates. And deposit outflows don't require physical presence. The Fed is a stabilizer, but digital markets, well, are destabilizers. It's kind of a race. So what does this mean for the future? I don't think the next crisis will look like 2008. I think it'll look more like instant withdrawals, instant repricing, instant collateral stress, instant shadow system contagion, instant policy response, right? The speed of money has changed. The structure of liquidity has changed. And really, the hierarchy of money, I think, is more important than ever. And this is just the world we live in. Once again, I want to thank you for listening to episode 39 of the Global Ledger. We talked about crises and why they happen so fast. We gave a case study on SVB and talked about the different reasons it will be faster next time. So once again, I'm Justin, and thanks for being here.